Good morning, this is Larry Edelson for my Uncommon Wisdom video for Thursday, January 28th. A lot of action in the markets this week. We've got some news that affected the markets, continuing news coming out of China and Beijing about the central bank there trying to cool down the economy in China. I do not believe this is bearish news as so many others have taken it. I believe that the authorities in China are doing the right thing. There has been some aggressive loan growth and credit growth in China. However, I believe the steps that the authorities in Beijing are taking are going to give way to a much more stable but still high growth economy, and I consider them proactive steps. I wish that our own Federal Reserve might have taken steps like this back when they saw the real estate market starting to overheat. So it depends on, again, how you look at things and how emotional you get when news comes out. Very often the emotional reaction is the wrong reaction in the markets, and are going to be reactions that cost you opportunity and put you in a situation where you're going to incur some heavy losses in the market. We also had some news about the Republican victory of Scott Brown in Massachusetts. This is significant. It is a telltale sign that the public is beginning to lash out against big government, if you will, and we need to keep our eyes on that going forward. Totally not completely unpredictable, the Scott Brown victory, although it caught many by surprise. I say that because the cycles that we're following in my work and in the Foundation for the Study of Cycles work basically foretold us that there would be an important psychological shift in the markets in the January-February time period. And the Scott Brown victory is a symptom of an underlying change that is beginning to occur in the psychology of the public. It is not necessarily bearish for the markets either, and I will go into that in future videos and columns on my Uncommon Wisdom and Real Wealth report. Initially, it's bearish for the markets, there's no question about it, but long term it may not, as the private sector begins to turn back towards themselves as being able to recover from this financial mess rather than relying on government. And that's a whole different philosophical discussion and economic theories that are involved in that, and I'd love to talk to you more about them and will in the near future. Let's go right to the markets right now. Gold is basically has broken down under this channel that I've been showing you. I was afraid that if that would happen, we would move down to test support at the 1080 level. We got down to about 1087 or so the other day. We'll probably see another test of this support level, maybe a fake out below it and then a recovery above it. I do not expect gold to fall apart here. There's solid support in this area all the way down to just under 1,000 to just above 1,000 down here at this line here. So we're still in a very bullish long-term bull market for gold. This is just consolidation after this huge run-up here from really going back before this chart here to mid-800s all the way up to 1,200. So we're just getting a pullback there. Long-term core golding should be held. You should not be phased at all by any of this action in here, even if we pull back to 1,000. Because gold over the next few years is going substantially higher to at least $2,200 per ounce. Let's take a look at the Dow now. Last week I showed you this chart. Maybe just pull it down for you, better view here. This formation here looked like it was going to create another wave up, and that's what I was looking at. I thought we'd get to 10.8 and up to 11.5. However, on the news that occurred over the last few days and over the weekend, the Scott Brown victory, rumors that Bernanke might not be renominated, which I believe is not the case. I believe he will be renominated. And the news pouring out of China, which on the one hand is very bullish, and then everybody's reacting very negatively to Beijing's attempts to tighten credit there, and I believe, as I mentioned earlier, that that's actually bullish, not bearish. Anyways, we took a swan dive in the Dow here. We're going to find some support a little bit lower, just around just under 10,000 in the Dow, around 9,800, 9,700 in the middle of this big white area here. I expect quite a bounce after that. I will say this, the short term is going to be very choppy and volatile in the Dow and in the stock markets, but this formation up here is not the kind of formation that leads to an important lasting high. This formation here will be taken out probably within the next 7 to 12 months, and we will see the Dow move above 11,000. I would only be concerned if we get a close in the Dow below roughly the 9,300 level, which is not a technical level on the charts, but a system reversal on my computer models. I don't expect that to happen, not very soon. Even if it does, we're probably a month or two away from that happening. We're more likely to test support just under the 10,000, rally back up to see what's up here around 10.3, 10.4, and then we'll have an important turning point. So I'm not panicking on any stocks over this move. It's drastic, as sharp as it was. I'm awaiting further signals. If the market's going to go a lot lower, we will have time to gear up for that and protect positions and or go short the market. I don't believe it's in crash mode. So don't get overly emotional on the markets right now. It's going to swing wildly. Don't let the emotions get to you because those are the worst types of emotional reactions are the ones that can cause you to lose money faster than you can blink an eye, and certainly also miss out on opportunities. So follow along with my videos and my Monday columns on